Hi everyone, welcome back to our Principles of Microeconomics video series. In our previous videos, we learned that markets can fail, and in particular they fail when the conditions of perfect competition do not hold. I'll put those on screen here. In our most recent videos, we focused on externalities and public goods. Externalities are situations where there is a benefit or a cost to people other than the buyer and the seller of the good. So on screen, you'll see a situation where there's a negative externality. And so in addition to the marginal cost of producing the good for the private producer, we have to add on the social cost of the good, the pollution, the risk of disease. And in such a case, what's happening is the good is being overproduced. There's too much of it. The last few units of the good that are produced have a marginal social cost that exceeds the marginal benefit, as measured by the willingness to pay of people using the demand curve. We also talked about private and public solutions. Private solutions involve bargaining and contracts. Public solutions involve taxing and spending. And we're going to spend more time in this video talking about the government's role in our economy. Let's get to it. In an economics class, we focus on the economic functions of government. We don't focus on its role as a provider of justice or the legal system. We focus on government's ability to fix market failures and to redistribute income. So taxing those who have succeeded in some sense in the labor market or in the stock market. And on the flip side, we focus on spending. And that can consist of subsidies, where we help people purchase a good for which there's a positive externality to try and fix a market failure. Also, the government can spend to finance public goods, such as our national defense, roads, public parks, and so on. The last thing the government can do to spend is to transfer money, so redistribute income from those who have it to those who don't, via things like Social Security, Medicaid, Medicare, and so on. Even though the government can use Pigouvian taxation to try and fix market failures where there's a negative externality, that's actually rarely what occurs. Normally, the cost of implementing and executing and administering and collecting a tax that's designed to deal with a small externality is more expensive than just simply ignoring the problem. Instead, taxes are usually collected on earnings, income, stock market returns, business earnings. And in particular on screen, you'll see the federal tax receipts for the last 50 or so years. And over time, you can see that mostly it's individual income taxes. And more recently, in the yellow color, things like Social Security and payroll taxes, so not just individual income taxes. And these taxes are designed to qualify you for a benefit in the future, so they're separate from individual income taxes. What does the government spend its money on? Well, I'll put a pie chart on screen right now that lays out all the various things that the government does. Some people make the joke that the federal government is a security firm with a good insurance plan, just meaning that most of the federal government's outlays are national defense, Social Security, Medicare, and Medicaid. And those are all just either defense spending or insurance against old age and health issues. On screen now, what you'll see is total federal tax revenue over time. And it's increased from about 10% to closer to 30% across the last 100 years or so. In addition, the red line shows total government spending. And you can see that at certain times, spending exceeds revenue, and certain other times, revenue exceeds spending. In particular, the two times where the spending exceeded the revenue were during the Great Depression and World War II era, and then during the Great Recession of 2007, 2008, 2009. When the government spends more than it takes in, they have to borrow money, and most of that money is just borrowed from US citizens by issuing what are called US Treasury bonds and bills. And so most of the debt owed by the federal government is owed to US citizens, banks, insurance companies, and so on and so forth. In particular, when the government spends more than it takes in, we refer to it as a budget deficit. And a budget surplus is when the government takes in more than it spends. And over time, that meant that they've borrowed more and more and more. And in total, the US government debt sits at about $28 trillion at the time I'm recording this video. So governments can collect tax revenue in two primary ways. They can have a progressive system where there are higher tax rates for those with higher incomes, and they can have a regressive system. And on screen, you'll see an example of a progressive tax system, one where each family, as their income increases, they pay a higher rate of tax, leading to a greater tax revenue for the US government. Each family, A, B, C, as they earn more money, they pay a higher rate of taxes and therefore a higher amount of taxes from their income. The alternative to a progressive system is a regressive system. And in a regressive system, the families with greater income pay a smaller proportion of their income in taxes, even though each family is paying the exact same amount in taxes. In the United States, we have a very progressive tax system. On screen, you'll see a chart with 3 vertical bars. The first bar just divides the US population into various percentiles. Basically, it's divided up into 5 percentiles, but the top percentile is further divided into the very highest 1% of earners, the next 4%, the next 5%, and then the next 10%. The next 2 vertical columns show the share of national income earned by each of these groups, and it's color-coded to match. So you can see that the top 1% of earners earn 14.9% of our national income. The bottom 20% only earn 5.1% of the national income. The third column shows the proportion of federal tax revenue paid by each group. So while the top 1% earns 14.9% of all the income in the United States, they pay 24.2% of all federal taxes. And if you look at the bottom 3 quintiles, the middle 20%, the next lowest 20%, and the bottom 20% of earners, they contribute a very, very small fraction of federal tax revenues. So how are taxes calculated for any particular family? Well, on screen, I'm going to show you an example with 3 different families. The first one earns $8,000 per year. The next one earns $40,000 per year. And the last one earns $75,000 per year. And what we're going to have is we're going to have 3 tax brackets. For a family who earns between $0 and $20,000, the tax rate is 10%. For a family that earns between $20,000 and $50,000, they pay 10% on the first $20,000. That's how tax brackets work. And then 20% on the remainder of their earnings above $20,000. For a family that earns over $50,000, they pay 10% on the first $20,000, 20% on the next $30,000, and then 30% on anything that they earn after that. So looking at the table, for a family who earns $8,000 per year, all of their income falls in that first tax bracket, so they pay 10% of that $8,000 income, $800 in taxes. For a family with $40,000 in income, they pay 10% on the first $20,000 and then 20% on the next $20,000 of their income. Because of their $40,000 income, $20,000 falls in that first lower tax bracket and $20,000 falls in that higher tax bracket. So 10% of $20,000 is $2,000 plus 20% of the next $20,000 is $4,000 for a total tax amount of $6,000. For a family with an income of $75,000, they also pay $2,000 on that first $20,000 of their income. Then they pay 20% on the income amount between $20,000 and $50,000, so $6,000. And then they pay 30% on the remaining $25,000 of their income, which is $7,500, for a total amount of tax of $15,500. This is an example of a progressive tax system. The family with the higher earnings not only pays more in taxes, but also pays a higher rate on each additional dollar. It's also important to define the average tax rate, which is just the amount of taxes that you pay divided by your income. So for the family with $40,000, they pay $6,000 in taxes and divide that by their income of $40,000 for an average tax rate of 15%. The marginal tax rate is different. It's the amount of tax that you will pay on the next dollar of earnings. So the family who has a $40,000 earnings, suppose they earned $1 more. How much in taxes will they pay? Well, that dollar of income falls in that $20,000 to $50,000 income bracket range for calculating taxes. So that $1 that they earn will be taxed at that 20% rate. So their marginal tax rate is 20%. They will pay 20 cents of every additional dollar that they earn until they go over $50,000. Then they would pay 30%. So some taxes get redistributed as transfer payments, including food stamps, Medicaid, and housing vouchers. To an economist, the question isn't whether or not these things are right or wrong. The question is whether or not they're efficient. And would a benevolent deity choose this for us? And there's a good argument that they would. They would take from those who have plenty and give it to those who have less, because that would improve efficiency. And economists often get criticized for criticizing programs that are designed to help poor people, because we argue that they'll be inefficient or that they won't work. But remember that economics is a positive social science. When economists argue that a program is inefficient or it won't work, we're not trying to claim that we shouldn't do it. We're just pointing out, as positive social scientists, the way the world works. The questions of whether or not a program is fair or the right thing to do are normative, subjective, and not really within the remit of economics. They're more philosophical questions and political questions. So let me illustrate why economists often argue against government's involvement in the economy, not from a normative or subjective point of view, but from a positive point of view. And the reason for this is that government can get the fix wrong, right? Suppose you have a situation with a negative externality and you've got a marginal social cost that exceeds the private cost of producing the good. The government imposes a tax on that good to try and correct the externality. But suppose they've mismeasured the size of the externality, or in many cases, they haven't measured it at all. They can impose a tax that overshoots the size of the externality. And so we get an inefficient outcome. Or undershoots. They get the tax wrong in the other direction. And so they don't actually correct the market inefficiency. In addition, imposing all these kind of taxes and regulations and trying to fix the market failures, which happen. One line that I always say is that all markets fail. Some are helpful. By imposing all of these taxes and regulations, there's going to be a need for an administration. And that administration is going to be costly to run. You're going to have to monitor people. You're going to have to collect taxes. You're going to have to follow them up when they don't comply. And it's going to be an expensive endeavor. Sometimes that expense is just not going to be worth it. In addition, the more the government is involved in an economy, the more people will try and corrupt the procedures that we have in place to try and keep everything above board and legal. In particular, when the government has a lot of say in our economy, it means that there's going to be people who want to try and bribe or otherwise corrupt political decision makers to do something that will help them. So the more the government is involved in our economy, the more chances there are for corruption. Even if people aren't engaging in corruption, they can also engage in lobbying and what's called rent seeking. And rent seeking is just trying to find a way to make a profit for yourself by using the apparatus of government to rig the market in your favor. And lobbying, it's totally legal. And on screen, you'll see a list of companies that engage in the greatest amount of lobbying in the United States. But all of this lobbying is extremely wasteful. If the government wasn't so involved, these companies wouldn't have to spend hundreds of millions of dollars to try and get politicians to vote for or against some particular policy. The third thing that can happen is that government involvement in an economy can lead to black markets, to illegal markets. So when the government says there's going to be a $10 tax on every packet of cigarettes, then people smuggle cigarettes across the border. When the government imposes taxes on corporate profits or stock market profits, then people have incentives to hide money in shell accounts in the Cayman Islands and the Bahamas and places where they can hide money legally and avoid taxes, which often means that increasing a tax can be counterproductive and lead to more illegal activity. Monitoring all this legal and illegal tax avoidance and tax evasion is a costly endeavor, and we need to have the Drug Enforcement Agency and the USCIS, the Immigration Service, the TSA at airports, and each of these agencies is just trying to impose or enforce some particular government policy. And all of it just gets really expensive and it's wasteful. So in some sense, economists view government as having two faces. Government can perform an important economic role in our society. But on the other hand, government involvement in our economy can lead to inefficiency, corruption, lobbying, rent seeking, and black markets. And so it's a bit of a mixed bag. And in a political philosophy class, you might learn about libertarianism, where the argument is that people know what's best for themselves and that government has no right to be involved in their lives so much. Economists don't really deal with these kind of issues. These are normative, philosophical issues. Our question is just whether or not government can improve efficiency or whether they make efficiency worse. Okay, that's enough for this video. In this video, we've taken a closer look at how government is involved in our economy, including looking at the ways it taxes and spends, creates budget surpluses and budget deficits, and borrows money to make up the difference, how they tax individual income rather than using Pigouvian taxes, and how government being involved in the economy can lead to rent-seeking, lobbying, corruption, and black markets. In our next video, we'll talk about tax incidence and then introduce the concept of monopoly. See you in the next one.